Welcome to This Explainer. The whole casino industry is entirely built on calculating risk and reward. But when it comes to measuring a gaming company's sustainability risks, investors really shouldn't be gambling. Today, we're going to completely demystify the alphabet soup of sustainability reporting. Specifically, we'll look at how global frameworks practically measure risks in a highly specific sector, the casinos and gaming industry. Whether you're an analyst, an investor, or just someone fascinated by how global finance is standardizing non-financial data, you are absolutely in the right place.
Before we get into the weeds of specific metrics, we gotta ask ourselves a pretty fundamental question. How do investors actually reliably compare non-financial risks across the globe? If one company is based in Macau, another is in Las Vegas, and a third operates entirely online, how do you know you're comparing apples to apples? Without a standardized language, tracking environmental, social, and governance risks is essentially just guesswork. We absolutely need a definitive system.
All right, here's our roadmap for today. We'll start with the global transition from SASB to the ISSB, decode the SICS classification system, spotlight code SVCA for casinos and gaming, cover 4 key disclosure topics, and then wrap it all up with the bottom line for investors. Let's get right into it. Section 1, from SASB to the ISSB. Let's start with the big picture and look at who is actually setting these global reporting rules right now. This timeline brilliantly illustrates just how fast these standards are evolving. Back in August 2022, the ISSB, that's the International Sustainability Standards Board, officially assumed responsibility for the SASB standards. Fast forward to June 2023, they aligned climate topics with new guidance, and by December, the non-climate topics were amended for international use. And all of this builds up to a super critical effective date for all entities, January 1, 2025. This isn't some distant concept. It's happening right now. As you can see, that historic messiness of ESG reporting, it's actively being solved. The SASB standards now proudly carry the badge of the IFRS Foundation. What this means is the ISSB is actively steering these standards into the future, committing to enhance and evolve them. For preparers and investors, you get the exact same reliable frameworks you're used to, but now with a serious weight of global harmonization behind them. It's a real game changer. Section 2, decoding the SICS classification. Now that we know who is in charge of setting the rules, let's look at how they actually organize the incredibly diverse global economy. The absolute linchpin of this entire framework is SICS, the Sustainable Industry Classification System. Basically, it categorizes 77 completely distinct industry-specific standards. This is how they ensure true comparability. So rather than throwing some generic sustainability questionnaire at every single company on Earth, SICE targets their exact business models and activities. So the crucial point here is that each of those 77 standards isn't just a basic checklist. It's a comprehensive toolkit. It gives you an industry description so companies can self-identify, outlines specific disclosure topics, provides hard quantitative metrics, includes technical protocols for exact scoping, and uses activity metrics. Those activity metrics are key, by the way, because they help investors normalize the data by quantifying the sheer scale of operations. Section 3, spotlighting code SVCK. Let's move to a specific case study and see how this elaborate toolkit builds out for the casinos and gaming industry. What's really fascinating about this standard is the strict boundary it draws. Code SVCA covers publicly held casinos, racetracks, and online gambling sites. But if a casino also happens to run a massive hotel or restaurant, those specific activities actually belong to completely different SICS codes. Things like water management for hotel rooms, not covered under SVCA. It is laser-focused purely on the business of gaming. This matrix proves that a highly structured, definitive guide exists for measuring exact risks in the gaming sector. Notice how the specific topics on the left map perfectly to quantitative metrics, exact units of measure, and unique accounting codes on the right. It essentially takes all the ambiguity right out of corporate reporting. Section 4, 4 key disclosure topics. We're going to quickly break down the specific disclosure topics the ISSB has flagged as highly relevant for casino and gaming operators. First up is energy management. Think about it. A lot of these facilities operate 24 hours a day, usually with very few windows. That requires massive amounts of energy for HVAC and lighting. So the standard forces entities to report exactly how much total energy they consume in gigajoules. And more importantly, they have to break down what percentage comes from the grid versus renewables. This is absolutely crucial for investors to measure a company's exposure to fossil fuel costs and climate transition risks. The second topic is responsible gaming. This is a massive issue where problem gambling can literally lead to severe regulatory backlash and lost licenses. The standards demand specific compliance metrics based on the medium. Physical facilities have to disclose the percentage of venues implementing the responsible gambling standards for venues, while digital operations have to track compliance with the RGC standards and criteria for iGaming.
Third, the standard tackles the complex financial impact of smoke-free casinos. Obviously, indoor air circulation exposes employees and patrons to health risks, like respiratory illnesses. But on the flip side, casinos often bring in significant revenue from smoking customers, while going smoke-free could be an opportunity to attract a totally new demographic. To model this, operators have to explicitly disclose two metrics: the percentage of their gaming floor area where smoking is allowed, and the percentage of staff man-hours worked in those specific areas.
Finally, the fourth topic is internal controls on money laundering. Because customer anonymity and massive cash volumes are just part of the gaming world, the risk of criminals disguising illicit funds is incredibly high. Entities have to detail their strict internal defense mechanisms, KYC protocols, enforcing caps on slot ticket redemptions, active transaction monitoring, and clear mechanisms for government reporting. Plus, they must transparently disclose any total monetary losses from legal proceedings tied to money laundering. Section 5, the bottom line for investors. Let's bring all of this micro-level data back to the macro reality for financial analysts and investors looking at the SICS framework. This quote right here captures the ultimate takeaway of this explainer. The ISSB doesn't require these metrics just for the sake of it. Whether we're talking about secondhand smoke exposure or energy grid reliance, it only matters here because it directly affects a company's financial prospects. These are sustainability-related risks reasonably expected to affect cash flows, access to finance, and the overall cost of capital. That is the so what of all this standardization.
So with the mandatory effective date of January 1, 2025 rapidly approaching, you have to ask yourself, is your portfolio truly prepared for these reporting standards? The rules of disclosure have been codified under the IFRS Foundation, and the data is about to become more transparent than ever before. Are you ready to navigate these new financial realities? Thanks for joining me for this explainer on the SCS SVCAS standard. Keep learning, and we'll see you next time.